Yeah, so first and foremost, I think it would be good to have some more clarity, or actually you already touched upon that, but how do you guarantee market liquidity? Do you have any measures in place to guarantee that or bootstrap that? I know Balancer has some, but yeah, I think it would be good if you could touch a bit on that. Maybe Jeffrey, if you could start.
Okay. Yeah, I mean, we're all about liquidity provision. I think, I'm not sure what the current thing is now, but there has been over $2 billion like on the platform. It drives in various value. So, we really leverage composability for things like liquidity. So, for instance, we have the boosted pools that I referred to. You could make a pool that is paired with a boosted pool, and a boosted pool it's like having 6 pools in one. So we have a BBA USD pool that's USDC and DAI and Tether, and also the AVA wrapped versions of all those tokens. So there's 6 tokens. So you can trade between, you can make a pool, compose that, and trade between your token and any of those 6 tokens immediately. And you have access to the full liquidity of that. And then you can build, you can also pair, you can make other composed pools with other kinds of stable coins and then pair with that. You can also make, things like indexes with large numbers of tokens that all can trade with each other. And also we have the order router. So you don't have to trade only within the pool. You can trade across multiple pools. And the way we have that, especially with, as one big swap, you can even join and exit and swap in one transaction across multiple pools. So that's very powerful for, liquidity. Yeah.
And you also have these bootstrapping pools, don't you?
Yeah, for starting it, yes, we have the bootstrap pool, and that's where, you start with a high balance of your token that you want to sell, and then a low a capitally efficient, low value of a token you're selling for, like usually a stable coin, and then as you sell it, the weights follow the balance down, so the price remains basically constant. So you can do over 3 or 4 days. There's no, incentive for bots to buy it in the beginning. It's very distributed. And we're actually working on a version that doesn't even need that. It doesn't need any seed capital at all. It uses our asset manager functionality. So you can start with no capital and launch a token.
That's great. Looking forward to that.
I mean, we've done over 300. That was my first project. My first project in Balancer V1 was the V1 version of the liquidity bootstrapping pool. We have one now, and we have other partners that have taken and wrapped it. There's Copper Launch that does that's a partner that does launches now. They've wrapped our pool, and then we're working on, and we've done, I think, 300, or we and they have done 300 some sales. I think 2.5 billion volume, something like that. It's been very successful.
Yeah. Okay. Thank you for that. And what about Swarm, Relio, or Fireblocks? Do you have any tools or services that can complement this or help create a liquid market?
So let's actually first of all acknowledge that there's obviously sort of a more complicated question around actually compatibility and counterparty risk if you look at liquidity. So the wider pool of today's DeFi crypto trading may actually not be compatible with certain actors that would want to actually provide liquidity. So if you're from the institutional space, there's some that take the position that they can actually do a risk-based approach that basically say, okay, we're going to do our transaction-based assessment ourselves. Others, because of compliance, they cannot engage. So to us, it's been always like the goal to actually serve both aspects, where we want to bring more liquidity that so far has not been part of the current ecosystem by providing these connectors to these traditional or maybe more adventurous institutions into the space. And if you go into certain verticals, it actually is more stringent. So if you look at a vertical like real estate, one of the key benefits from digitization in this case. So Germany, for example, has transaction costs for real estate of 10.5% or something to that tune, right? So if you can digitize and you don't have to, incur the full stack of transactions, maybe that goes down to 3%, 5%, but still that's an significant economic uptick, right? So by actually putting even the smallest of real estate into an ecosystem like that, the professional trading organizations and the brokerages have a benefit from actually engaging in the digital version of it. And so, and they can actually provide the markets themselves. So the whole concept of actually the asset holder being the liquidity provider, it's a feature, it's not a drawback. It's actually something that the entire category can benefit from and are starting to realize that. So it's less about connecting, for us, it's less about connecting sort of the wider liquidity of DeFi and cryptocurrency with real estate, but rather to provide tools that exist and benefit the entire category of real estate and make it composable, and even the smallest ones make a price discovery that works and doesn't have too much slippage. So that's where you need to go for OTC rather than for pool-based transactions that are incredibly better in terms of like price discovery than if you look for Blackboard-based systems that are, unfortunately the US and all ATSs in the US are basically still Blackboard systems that are anything but real market-based pricing. It's basically anecdotal price discovery. So I think that already bringing this kind of version to that space is already going to provide incredibly increased amounts of benefits.
Yeah, absolutely.
I would say just on that point, it's not a tools problem. Right now, it's a liquidity problem. We've all the tools for building pools, the tools for creating liquidity are there. We know how to whitelist them. We know how to make them in a compliant way, but we need participants to come in, right? You're either going to find a ton of organic market liquidity, like you found on Uniswap, and there are professional firms that actually provide large amounts of liquidity there. You just don't know who they are. They're all pooled together. Or we need to get big market makers involved in the digital security space. And I think that's going to happen. We actually need both of those things to happen, but it's a chicken and egg problem, right? Because liquidity providers are there to make a profit. And they take risk with impermanent loss if you're talking about automated market makers. So we need volume. They get fees off of volume. So, I think the liquidity argument, which one's going to come first? It's going to have to be the liquidity. So, as an industry, we're going to have to start providing it, right? We need the organic side of it to come in. We need the volume to come in, and then we need the big players to start, participating as well. And that's how, the liquidity market can become more robust than it is right now.
Yeah.
Maybe, sorry, I wanted to add something there as well. I do think, the biggest challenge that we see, and I think Philip mentioned it also before, we have Germany as a very strong industrial nation to come quite forward, especially BaFin, with some regulatory aspects that allows highly regulated institutions, to participate in something like crypto or digital assets, Web3, whereas, there are a lot of the nations are still very much behind to even allow, the institutions that could provide, large amounts of liquidity into the market to even interact with it. And I think one very interesting project that we saw recently was from, the Monetary Authority of Singapore, MAS, that launched Project Guardian, that is actually suggesting that you have a KYC or permissioned DeFi pool for regulated institutions to participate in there. So, because, that's the problem that we still have with the regular DeFi pools, that you don't really know who you participate or who participates, and that you just for regulatory purposes cannot interact with it because you can't prove, where the money is coming from, who you're financing. So I think, that's also what Swarm obviously followed, to be fully regulated on that side to enable large institutions to participate. And until we have clear regulatory insights or guidelines, I think, we're not going to see the mainstream adoption that we want.
Yeah, and I would add as well, something that is evolving in a large way is mortgages that are backed by Bitcoin, right? Most of these services and these platforms that provide this are centralized, right? You you're basically giving your Bitcoin to them to hold until you repay the debt. But there is potential to take advantage of existing liquidity that exists in the DeFi space, mostly on Ethereum, because that's where the most liquidity is, but it's evolving into other chains. But if we start to look at our ability to borrow against or to borrow against digital assets to purchase real world assets, now we're merging existing liquidity to get and acquire real world assets. And if we can get these real world assets now on chain and mix the pools, we have a big advantage with the existing DeFi landscape in that regard. That's actually something that we're working on at Relio as an attempt to provide a DeFi alternative for mortgages for homes. But we'll have more on that in the coming months.
Yeah, sounds interesting. Absolutely. And I think what you said before about liquidity providers, sort of the chicken or the egg problem that you have right now, Alex has a nice question that ties into this, asking if you're not incentivized to be a market maker, why would they be incentivized to be a liquidity provider? Is there anything you can do to attract liquidity providers, or do you simply have to wait for institutional players to provide the liquidity? Or how would that happen?
So I'll comment on that. I think you have to think of different markets and assets in a progression, right? So if you have a certain real estate asset that actually doesn't have a public market because it's just been freshly sort of put into the semi-public market, either as an STO or as a public security, well, it is in the interest of the owners of that security to actually make their own market. And it might actually justify to have extremely high fees that someone transacting there has to pay to the liquidity provider until the market becomes more liquid. So because it's a lower frequency of tradability, there might be excessively high transaction fees that justify, or they're subsidized by some other means by the asset holder, the issuer, that then incentivizes us in a different way. Now, while the market progresses, it becomes more liquid. Obviously, then the fees, the swap fees, and the pools can actually go down, because then it becomes easier to attract capital. So there's not the one or the other kind of response to this. I think what we are experiencing right now is that that a lot of the issuers are suddenly starting to understand that they, as issuers, can actually put sort of their assets into this context, and they will actually start to generate yield. What that yield looks like and how big that is really dependent on how they create their market. So it's almost in the hands of them marketing their own market in their context, which often they're doing today anyway, right? So if you have someone promoting their real estate fund, or they have their own real estate that is being brokered, it is no other activity than generating sort of traction for their assets in investor landscapes that then come in. So there is no longer the necessity to think about the market maker and the liquidity provider in a separate function. And I think that is the beauty of actually the AMM model that Jeff and others have helped promote, to make that as simple as it can, and you don't have that bifurcation of professional firms that need to understand the order sizes and so forth. But there's a much easier way to understand what's going on and actually participate in that market.
Yeah, absolutely. Good insights. And I also just want to throw the ball to Mark, just to envelop him also with real estate.exchange, what your view is on liquidity, and what exactly you plan on doing in that regard.
I think it's a bit difficult to add more. There's a lot of brain power in this room. And a lot of good things have been said, but I think what resonated with me the most is that liquidity is king here. We got the tools, we know how to do this now. Liquidity is now what is needed. And for that, we need institutions, we need, safe protocols. What I would like, sort of a shout out to the industry, is to put more focus on, auditing, making your protocol secure, because the more we see all these hacks happening left and right, it seems these days, the more hesitant we will see both users and institutions coming in. Balancer, just to throw a little nugget to Jeff and his team, Balancer has historically been extremely good at safeguarding and putting security first on their protocol. I don't know if you guys are still number one on DeFi safety, but you used to be, at least, Jeff.
Yeah, we
That's
had
also one of the
first
reasons
one to get
why.
100% rating. Yep.
Yeah, exactly. Which is also one of the focuses that we had, because we know our customers, they will have that as the top priority for them. And then second is liquidity.
And I'll also add that, on the utility token side, you can also, the liquidity of the security tokens is a separate problem, but when you have something like real estate exchange where you have the brick token, that's a utility, then, you have all the capabilities, all the functionality available on Balancer to build, make pools with brick, pair them with yield generating tokens, participate in liquidity mining. You have ways to grow your brick stack, organically, which then can be put over the fence, on the other side. So that's one aspect where you don't need to worry about securities if you just on the utility token side.
Yeah.
Plenty of
That's a good
liquidity on
point.
that.
Okay, so I'm just gonna see what else. What other questions there are? There's one here asking what regulatory changes are required to allow for further adoption of digital assets, and more specifically security tokens, by traditional finance. And I know Philip and Derek, I think you already briefly touched upon that, but I think if you just briefly could summarize your position, your view.
Yeah, okay, so I think we have come a long way. And I think the last 2 years, there's been a lot of rails being put in place in different jurisdictions. Obviously, we favor, the German one, and we have questions around others that are not really there yet. It's about going through the process and actually sort of educating the regulator along the way what that means. And that's what I was referring to in this presentation is of it, we've been putting some, in their minds, mind-bending concepts in front of them and saying, okay, so, but it's worthwhile to push that through and have them accept this new reality that, for example, there is no control over an order book or anything, right? Or that self-custody means something and it's a purpose, right? Or that the embedding of other tools like Fireblocks or other wallet infrastructure matters and is different than actually the trading venue. So there's a lot of things that, obviously, I think we're now in a position that we can do things. Now it's about taking off the training wheels and actually getting that out there and proving that the market can actually work with these tools, right? And this is luckily in Germany a little different than, for example, in England with the FCA that is still working with sandboxes. We are now capable to actually do this in real time with real market participants with real capital, and are not necessarily having, well, we still have to prove on a daily basis that we're worthwhile to operate this way. But it is an early market, but I think a lot of the impediments have been sort of put out of the way. So we were lucky that we're invited to actually help the German finance minister think through some of this. And my standard sentence to him is actually, don't fuck it up. Because right now regulators can get in their own way. And right now, actually, if you look at the national regulators and European regulators, and then the OFAC and other coordinated efforts actually coming together, there's a lot of good reason to believe that still red tape can prevent good things from happening. But I think there's enough people in recognizing the goodness and what it is and where it can lead to that are willing to take it as a trial to actually see the first explorations and go that next step. But I think we're there. I think the next 12 to 24 months are going to be extremely exciting because, let's be honest, for the next 6 years, it was the year of the STO and it never happened. I think this is very, very different today.
I agree with all of that. I think in the US, there's, getting or redefining accreditation rules is an absolute must. That should have been done years ago. But having money doesn't make you smarter with your money. Just having more of it, that means nothing. And so much of the market is just eliminated from interacting with securities because of this. It doesn't make any sense that use the test, whatever it is. There's a lot of proposals that are better. But if retail, is now with an opt-out or some sort of test, able to participate in a Reg D 506C offering, we've immediately, you know, that's a great offering, right? And the market can develop around it. Lockup periods, you know, they can be good for the issuer because, you know, I think the market gets a little bit too antsy sometimes before they don't have any patience. So sometimes lockup periods can actually benefit the issuer and the investor from themselves, right? If we protect them from themselves. So, you know, I don't know if that really needs to be defined, but we got to eliminate accreditation rules. You know, that's an absolute must.
And Derek, just to highlight what you said earlier, you know, 100% agree with actually the transfer agents no longer having a role. And then we have to talk about actually then central custodians possibly also going away. That is, unfortunately, America is going to be taking a long time before that happens. But that is absolutely a must, because otherwise you're creating, like, you know, paper-based processes as the foundation for a blockchain to operate. And, you know, it's like square peg round hole kind of situation, right?
Yeah, it's redundant and unnecessary.
Yeah.
That's what tech is for. We make things faster, cheaper, better with technology, and that's always the winning path. That's the natural progression. You know, we just need regulation to catch up.
Yeah,
absolutely. Good points.
Yeah, and maybe also what I want to add on that, I think Derek and Philip made really good points. And, you know, when we see now regulation allowing those institutions to dip their toes and test it out, I think then it's also down to us, you know, to continue educate and make them feel comfortable, because obviously it's all new waters for them. I mean, we all had conversation with large traditional financial institutions where, you know, there's still a lot of education needed, a lot of comforting, and make sure, you know, that they achieve and whatever they want to put to the market is also going to be successful. Because if that's not going to be successful, you know, maybe others will stop trying. So we need to have successful projects when it's not allowed. We need to make sure that those are going to be successful.
Agreed.
Fully agree. Fully agree. Thank you for that. Okay, so I think we're just going to take one last question, and I think it would be good if we could hear all of your views, just briefly summarized. So we have a question here saying the World Economic Forum states that the 1800 trillion market is open to blockchain. How do you see tokenization market evolve? What are the limitations and what are the key barriers to mainstream adoption? And we already touched upon that, but starting with Mark, I think it would be good if we just could get like a quick summary on what you foresee in terms of tokenization.
Well, I think I'm known for saying that this year was supposed to be the security token year. And someone said on the call that never happened. So I'm still betting on that, to be honest. Securities will have its day in crypto, and I'm sticking to it. That's what I think we will see more of. I think we all agree on this call that all kinds of assets will be not just recorded, but also traded and transferred on chain. Securities will be a huge step in that direction. So that's what I see coming big time.
Agreed. And what about you, Jeffrey? How do you expect the digital asset market to evolve in the coming 20 years or so?
20 years.
That's a long time, yeah. Big question.
That's like centuries in crypto. It's hard. Yeah, it's hard to even look ahead a year. You know, yeah, mass adoption is tough. I mean, and even especially with securities. I mean, really, even what percent of the general public even owns securities normally, right? It's actually not that many. So, and then the percentage of crypto penetration, even though, you know, it seems to us like, oh, everyone's doing it, it's not really, right? Compared to the full population of the earth, very, very few people are in it. So that you've got two kind of low probability things. So, you know, a lot of it's, I think in addition to the regulation stuff, it's just the trust in it, I guess, because for it to be mass adopted, it has to be easy. So there has to have to be, you know, UIs that they're decentralized underneath, but they look like the familiar centralized things that people are used to dealing with. It looks like a bank. And a lot of the apps like Robinhood, you know, is going in that direction where it's a friendly app that looks like everything else, but it's actually tied to, you know, finances. So I think the usability is one important aspect. and then just the trust in it. And that's maybe the biggest thing is that people have to trust it. You have the media and you have all these crashes and scams and, at some point you have to separate the wheat from the chaff there, and people need to trust in what they're doing.
Yeah.
I think Balancer is kind of at the forefront of that, and your reputation, having a strong reputation for safety and ethics, which is lacking in the central. When they realize it's actually easier to trust, a well-founded protocol than it is humans, and we've just seen this in the recent, CeFi versus DeFi. You actually, it removes the human element, so you actually don't have to trust people. But that's a big education effort, and people aren't. The general public isn't anywhere near that yet, I'm afraid.
No. Hopefully, at some point. Okay, thank you. And Philip, do you want to give your view on things?
Yeah, so I think so. First of all, it's worth fighting for this because obviously when you look at bond and equities, they're 100 trillion, and then you have sort of derivatives that are 700 trillion. This is like orders of magnitude bigger in terms of the honeypot than actually the current crypto market is. So if we get it right, there's a big payoff, right? But I'll put the two main aspects actually sort of front and center. So first of all, I think let's talk about value add. So first of all, we all talk about like what the digital securities have in terms of value add, and we want to believe that it's cheaper to engage, it's faster to execute, the price discovery will be better, yada, 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 transparency is there. Well, we have to prove that, which means that and I think Derek was referring to this, like we have to prove on a case-by-case basis that actually this holds true, this claim, right? And that's not necessarily always the case because regulatory is a bitch and it's really hard to execute on. The discovery process organizationally about dealing with technology is challenging, and Fireblocks can speak to that probably because engaging different roles in this new way of interacting is really hard. But even if you get that all right, we've so far only spoken about basically this. I can always compare it to when the web started. New York Times being distributed by PDF was already a benefit. But it's not what really made everyone engage. It was that suddenly content was done differently, right? So New York Times today looks very differently than that PDF that I was sort of referring to. And I think we're going to find the same thing happening in this space where we all have to occupy those white spaces of what else can you do with securities that so far you cannot because it's actually in the traditional space. So maybe it's a more fluid way of doing lending or actually having one balance sheet for crypto assets and normal assets that you can actually use to do certain things. Or it's actually the benefit of actually having a cross-reference of a security that benefits then a customer relationship. So because I'm a shareholder, I get something differently from the customer. Those things all we've spoken about for years, but now it's about actually sort of bringing people to prove that out to make it not just like 10 to 20% better from a cost stack perspective, but really like orders of magnitude different from an experience set. That's one thing. The second thing is experience. And yes, UI matters and experiences matter and trust matters. But it's also equally that I think we need to talk about the friction points, meaning that, we can't have AML or KYC in 15 different places and uploading documents everywhere. It has to be something that works as smooth as Facebook Connect or some other trusted service where they're not the trusted service. So something that actually brings people to see this as a appreciative process and not something that just is as equally burdensome as the banking sphere is. So, and that's a challenge. That's a very big challenge because it's not easy to solve that, right? But yeah, that's sort of the three aspects I'm looking at.
That's good. That's a good answer. Thank you for that. And Derek?
Yeah, I think I went over one of my slides was specific to this. It is tough to predict what's going to happen, but I think we have to first we have to rethink what our interaction is with investable part of the securities, because it's if blockchain as a technology is going to solve a problem, it's going to create new problems, but at the same time it redefines the way that we hold and manage assets. So, for me, DeFi is the most exciting component to this, the ability to have real world assets that we traditionally would have, but now be able to leverage them. I can stake my house in Aave and get a mortgage, right? And it technically could solve some of the other challenges that we're bringing up on this webinar, where some issuers may not want a tokenized component of their capital stack because the senior lender won't lend to them. Fine, I'll go to I'll go to a DeFi protocol and get the full thing. I'll get the full debt off of that, right? So I've completely eliminated the too risk averse component because I understand the technology and I'm comfortable with it. So yeah, I think the ability to interact real world assets with DeFi is the future, and that's what I'm most excited about.
Thank you for that. Okay, so Nicholas, if you could give your view on what the future for digital assets hold.
Sure. I think, I have to agree with everyone who answered before. It's always hard to predict, and there are a lot of challenges, but I do believe that, when we talk about digital assets, there are so many components that we already see companies engaging from various perspectives. And if we just take a look at, what ANZ is starting to do, they started to tokenize the Aussie dollar. Now we have, large PSPs like checkout.com, WorldPay, many others, starting to leverage blockchain technology to make any type of payment, whether it's cross-border payments, whether it's merchant collection, payouts, much more efficient. And then on the other hand, we obviously have now companies that start to, whether it's, tokenized real estate, whether it's gold, securities, whatever it is. But I think the ultimate end game solution that we would like to see, because current financial system is very based on promises, right? If I buy a stock somewhere, there's a promise that I bought this stock. It takes some days until it arrives. It's just a promise that it's, owned by me. And if we look into, whether it's going to be stablecoin, CBDC, and tokenized assets, if we can get to an instant DVP where I actually hold, the token represented in my wallet, it shifts, from just a promise-based system to actually physically, digitally, then me owning that part of the asset that I purchased. So I think, this is where we hopefully going to end up at one day. It's going to take a while. And if you ask me, if we take a look at what Philip presented earlier, the slide with all the different participants in the actual flow today, it's going to go step by step, right? We're going to try to remove a counterparty and then another counterparty. It's not going to happen from today to tomorrow that everyone's going to say, okay, now we do it as the second slide showed. Did you have buyer and seller interacting automatically? I think it's going to be a testing what works, what regulators will feel comfortable with. And if we prove then that it works and it has benefits, then we're going to see the next step. So I do believe it's going to be a step-by-step thing, but we're going to get there.